Welcome to Wage Zero, where I share my knowledge to build wealth and make work optional. Today is my first video, and I'm going to show my dividend portfolio where most of my capital is allocated, since I believe that dividend investing is one of the best ways to build wealth steadily and with peace of mind. So let's go through all the holdings of my dividend portfolio from the largest to the smallest. First, we have Johnson & Johnson, a top healthcare company. They have a strong balance sheet. They are dividend king. They have been paying and increasing the dividend by 6 decades. And they sell pharmaceuticals and medical equipment. Very stable company and a top pick for every dividend portfolio. Samsung Electronics. You might be surprised to see this peak here, but I wanted to have some exposure to tech, and also I wanted to have at least one foundry, the other two being TSMC and Intel. And turns out it was a great decision, given the current demand from memory for AI. United Health, leader in health insurance in US. They have a good track record, although they had some problems in the past recently. But I'm very comfortable holding this very needed company in the healthcare sector. Nestle, the biggest consumer staple company with a tremendous portfolio, ranging from snacks like Kit Kat, some bottled water, some coffee products like Nescafe, uh, Nesquik, drinks also like Nestea. They made some mistakes. They took, in my view, too much debt to repurchase shares in the past, but I think they will do well with a new CEO. They just need time. Merck, top pharmaceutical company, they had the most sold drug in the years 2023, 24, and the first half of 25. It was Keytruda against cancer. And I think they have a great pipeline and have the ability to keep delivering good drugs. Louis Vuitton is the largest luxury company. It's not really for the super rich, but it's a more aspirational luxury for people with high income. For the super rich, Hermes will be the one, but it's in my radar for now. British American Tobacco. Tobacco companies were hated a couple of years ago, but yeah, companies they evolve and now they are shifting into products with less nicotine, also vaping. And this one, well, in general, these tobacco companies they provide a very high yield dividend, so a nice one to have. Novo Nordisk. It was once the biggest company by market capitalization in Europe. The pharmaceutical company, they make weight loss and they made a lot of money, but then Eli Lilly just took a big chunk of their market. I think they can recover. I think the obesity and the diabetes market is big enough for many companies to make money. Just hope that the new CEO is focused and let's see what happens. Abbott Laboratories, another healthcare company. They sell pharmaceuticals, medical equipment. They have been compounding over the years. Stable company, not a lot of yield, but a good one to have. PepsiCo, yeah, another top beverage and snack company. They don't only have Pepsi, but they also have snacks well recognized brands like Lay's, Doritos. I'm also looking to add Coca-Cola, but it's difficult to find a good entry in that one. McDonald's, the largest, I think, restaurant chain, but they don't actually make money by selling food or burgers. They are more of a real estate agent. They basically have a franchise system, and the franchises they pay the rent to McDonald's, and they also pay royalties to use the the brand. Pfizer, another pharmaceutical company, they made a lot of money during COVID with vaccines. They didn't um, took that opportunity to shift to a more profitable strategy, and they collapsed. It's not one of the best companies I have, but they have a very high dividend. So I will just wait to I will wait for things to improve. Meanwhile, I get this nice dividend. Blackstone, not to confuse with BlackRock, with people know. Blackstone is a alternative asset management firm. They are the largest. They are into private equity, real estate, infrastructure, you name it. Um, it was down recently because private equity is high liquid. When there are market downturns, people panic and trying to withdraw, and they see that there are withdrawal limits, and people panic. But I think it's a good one to have. Automatic data processing, another dividend king, is a payroll company. They have global presence, and they also have a bit of outsourcing, and they have been paying and increasing the dividend by 5 decades. A stable company, I think, is a top pick for any dividend portfolio. CME Group is the world leader in derivatives, so they have futures and options for a lot of instruments like equities, commodities, um, currencies, even cryptocurrency. And the things that I like is that all the money that they make, they return it to shareholders via dividend, and it's very asset light. So I love those two things, that they give you high yield and also it's asset light. So we have UPS, one of the largest companies, shipping companies. It's not going through the best moment, but they pay a high dividend, and I can just wait. Meanwhile, I get paid to things to improve, hopefully. Brookfield Asset Management, another alternative asset management firm. In this case, they manage the assets from the parent company, Brookfield. They have all the assets, and these they just manage them for a fee, and they also have performance fee. It's interesting Canadian company to have some diversification there as well, and have been increasing the dividend at a high rate. Nike, we all know about Nike and how it crashed. As a nice clothing and footwear company, they made bad decisions recently, and now they are suffering the consequences. But I'm confident that they will make out a way. They will find a way out of this situation. They just need time. Uh, let's see. But what I like about this company is that the brand recognition is quite strong. I see people on the street wearing Nike all the time. It's the most visible, the most frequent sports brand that I see in the street. So I'm just waiting for a turnaround. That it may take more time than I initially expected, but it is what it is. Diageo, beverage alcoholic company. Alcohol is not in the best moment. I don't usually like alcoholic companies, but Diageo has great margins. That is what I like, and they have recognized brands like Guinness and Johnny Walker. Um, so hopefully they will um, find a way as well. Just waiting. I think the current CEO is very focused. They cut the dividend to really try to fix the company. I prefer that than just pay the dividend and wait for the best. I think CEO is taking actions in the right way, in the right direction. And then the last one, so it is a pharmaceutical company, spin-off of Pfizer. And this one focus on animal and pet health. They had great margins, great return of equity, return of invested capital, but the growth is a bit stagnating right now. But still a good company. These are the 20 companies I currently hold. Now you have some insight about how I invest. I mainly look for sector leaders, companies I think they are going to be here the next 100 years, because I want to hold them forever. I want this portfolio to outlive me. I want this to be inherited by my children, and I want this to be my legacy. So if I look at sectors, I'm overweight in healthcare and a bit in consumer staples, but that is because they were cheap, and I was buying whatever was cheap at the moment. I think this is the good way to do it. Others might want to diversify it, even if the sectors are expensive. But for me, that doesn't make sense. If I buy something that is expensive, okay, I'm diversified, but if I lose money, I don't care if I am diversified. I prefer not to lose money. If we look at regions, I'm overweight in North America, but that is because the greatest companies are in North America. So it is what it is. I don't want to impose some strict rules about country diversification in my portfolio. But I will try not to go beyond this 60%, which is more or less 2/3 of my portfolio. I think that's enough exposure. But let's see how it goes. I just want the best businesses. I don't care too much about where they are from. This is the dividend calendar. Here you can see the dividend distribution across the months. And probably this is something similar to your case, because most of the companies they pay quarterly, so most of the dividends they come from March, April, June, September, and December. Yeah, I think we cannot expect to have the same amount of dividends every month, like an income. One way could be to add, companies from other countries that they pay different times, maybe biannual or just annual. Maybe some companies that they pay every month, like realty income. Let's see. So far, I'm happy how it is now. So about the performance of individual stocks, you can clearly see the winner, right? Samsung. But if you forget about Samsung for a moment and you see the other ones, they look very symmetrical, right? So it's like there are the same amount of winners than losers, and the same amount as well. So you might think that without Samsung, uh, performance was just flat, but it was not the case, because one important thing to note is that the positions that are green, like United Health, Johnson and Johnson, Merck, there are one of my biggest positions, buy-in positions, and the ones with the largest losses, like Nike and Zoetis, they were the smallest position. So there was performance because my top holdings were winning, while my bottom holdings were losing. And of course, then if you add Samsung to the equation, then performance was great this half of the year. Samsung was just like a rocket, went up every day. It was probably my best investment so far. Also because it was my largest position, and it was once 25+% of my whole portfolio, and I've been trimming the position already. So yeah, big win there. So about the total performance of the portfolio this first half of the year, we can see here in the chart in green my portfolio versus the SP 500 in purple. I got a 23% of performance versus about 10% of the SP 500. Um, this is not normal to have this kind of performance in the first half of the year and also above the SP 500. So one important thing to note here is how exposure to tech can give you much better returns than the traditional dividend portfolio. In my case was Samsung, who gave me this additional performance. And some things I want to mention first. Don't get fixated with the performance because we are a dividend investors, right? So we should care about dividends and not so much about the performance. And in fact, I will expect to have less performance at the SP 500 because they are more about growth, right? And we are more conservative investors. And another thing is that it's important to compare your return, right? We don't want to see the return just in the vacuum, but compare that to the index, in this case the SP 500. So let's see how's the second half of the year. I will be happy if we just can keep this return.